That's how he wants it. Yeah. He used to want it to be a big secret. Everybody would be like, no. Joe now. The borderline divided. So he bought half of that, half of that he wanted to go. The other half wanted to stay. Oh, that's such a big wow. Because whatever. You should probably get along. The face of the live Carter. Yeah. So this is where it's at. It's like there. I had one call. No, I didn't. If you're easy going, A lot of stuff. Well, I was tired. I need to go back. It's a lot. I am 25 minutes. Phone call. Or radio call. We've been here half an hour. I've got this before call the one guy who's playing the I'm the guy. It's one of the stories. Whatever. Oh, that transformer up here. Load the transformer alone. While you sit up there and wait for it to call the guy. Yeah. It's realistically most times.
Good evening. How's the volume out back? Good. We're going to get started in about 5 minutes. A couple of people still getting checked in. Bathrooms are right here. Male and female are on this side. If you do have to smoke, they ask that you go out to the back to smoke. We got plenty of pizzas. We're going to probably let y'all bring a bunch of pizza home. Speaker just got here, so we're getting him set up for mics, but we'll get started in a couple of minutes.
It's a lot harder. Very rare. We can sit together. Just fine.
So it's got that behind you. We need two over here.
Two over here. Oh. Yeah. Wow. What do you think about this?
All right, we have a couple of flyers going around that will be part of the presentation tonight, so if you don't grab one, make sure you get it. Robert, how was that game yesterday? I see you're like the one fan in here. Who likes the Bears? You. Who doesn't like the Bears? Who's everybody's teams? The Colts, the Steelers, their season's done. Well, I don't think they ever had a season, but the Bears are what we expected. Hey, that was an up and down game, right? I watched the last 2 minutes and I saw all the fun stuff. My team had a rough game. I almost bet them on the over, and I didn't because they never do well. And they did okay.
Who's that?
Patriots?
Oh, of course.
Well, the last 5 of the last 6 games down in Miami, they've lost. So last year was the one where they lost on the Hail Mary at the end, and Gronkowski didn't tackle him at the end zone. So, I mean, a 19-point spread's pretty big.
That was a good game.
Tom, are you around?
Yeah.
All right, well, welcome everybody. Good to see everybody. Again, this is Invest NWI. I'll make sure you're in the right place. The premier investment group here in Northwest Indiana. We started the group 3 years ago with the whole goal of just bringing together investors of all different levels. We have people in here that have never done a deal, that just heard about real estate investment, to people that have done hundreds of deals and made millions. And the whole idea is just to bring everybody together to provide a place for relevant real estate education. Tonight's topic's a little bit different. It's going to really apply to people that have already been around for a while and have done some deals. But it's definitely something that new folks should know about so they can be proactive when they're in this situation. Also a great place to grow your personal network. Here are some of the benefits of the group. The biggest thing, and I've shared my story in the past, and I was just sharing this with Marcus. When I got started in real estate, or the desire to get started in real estate back in 2015, I didn't know a whole lot about it. I had one rental at the time, but I started going to a group in the area. And I started meeting with people at Dunkin' Donuts and McDonald's and asking them about their experiences and how they make buying decisions, because I wanted to get into wholesaling. So if I'm going to find houses for people, I got to figure out what they want so I can find them what they want. And through the network there, it helped me become who I am today. And some of those first connections I made in that other group, I'm still selling them properties. I'm still going to Dunkin' Donuts with them. So great place to build your network. Real quick, the material and content presented today is for educational purposes only. This is not legal advice. You definitely want to meet with your own professional people, whether that's your CPA or your attorneys, before you do anything. Definitely do your own due diligence. There's been a couple of issues, and I've seen a lot in the last couple of weeks, and I don't remember if it's on the Facebook page, a couple of people complaining, or they've reached out to me, or I saw one just a couple of days ago on Bigger Pockets about someone in the area. It seems that there's been a string of bad contractors lately. So if anyone in the group recommends someone, you definitely want to do your own due diligence. We're dealing with a contractor now, and we realize he has a pretty big rap sheet and owes a bunch of people money. Had we done a background check on this individual prior to hiring him on a project that's probably going to be a $125,000 rehab, we probably would have made a different decision. So we're even modifying how we're vetting contractors, but don't just take someone's word in the group or anybody's word that that person is legit without doing your own due diligence on that. Again, speak to your professional circles, ask a lot of questions. I know a lot of times you don't like saying no to people. It's hard to maybe hurt someone's feelings or ask those tough questions. Well, I can tell you from experience, it's a lot easier to do that on the front end than to realize when you're halfway through a project, they've taken all your money and your house is in worse condition than when you got it. So I've been there. It's not fun. Like any investments, real estate has risk. Sometimes you make a lot of money and sometimes you may lose money. So Tom, I need your help. Who did anything this month since our last meeting? Anyone go, not go because it was online. Anyone buy anything at the tax sale? Anyone bid on anything? No? I heard the prices went crazy high. Someone was telling me about a house, and I tried to buy it before the tax sale, and the person didn't want to, and it went for like $160,000 in Highland, which, given that you don't have a clue what it's going to look like in 18 months when you actually take ownership to it, it's kind of crazy that someone local, it wasn't a hedge fund that just wants to collect interest, it's someone local that was hoping to get the house to rehab it. So hopefully in 18 months when they get their deed, the property values are still there. But anyone do anything? Buy anything? Sell anything?
Did a private loan out of my self-direct IRA.
There you go. Is that your second one then?
For you guys.
Oh. He did a loan out of his self-directed IRA. So when the loan's paid back, all of that interest goes into his self-directed IRA, so he won't be taxed on that this year, which is pretty fun. Tax-free growth. Anyone else do anything?
Sold another turnkey to Terry.
There you go. You're going to buy that one we talked about today?
Yeah.
There you go.
For $7,500.
Hey, I am buying one next week for $4,000. So the previous tenant. It's up in that central part of Hammond, so who knows what it's worth. But the problem is the former tenant didn't like the landlord, so they took their fist to a lot of the walls, so the whole house needs to be re-drywalled. So, if you're not on the Facebook group, you definitely want to go to that. Just go up to the top of your Facebook app and search for Invest NWI Investor Group. If you just put the Invest NWI part, that's where you'll go to our wholesale page where we post all our wholesale deals on Facebook. You got to put in the investor group part. And that's a great place where you can ask questions if you're looking at getting into a, maybe you want to buy a rental property, you're not sure if the numbers make sense. You don't have to post the address, be like, hey, I'm looking to buy this house. It's a 3-bed, 1-bath in Hammond, in Hessville. I think I can get $1,000 for rent. They want $95. Is this a good rental? And you'll get a bunch of good feedback there. We have people that are asking for contractor references, plumbers, electricians. Again, vet those people. But if you're in a bind and you're looking for someone, it's a good place to get references from people that hopefully have already used them and had good experiences with them. So We also post on that page there our upcoming events. This one, it didn't get posted as quick because the topic we were going to have, the speakers I had for that had scheduling issues, so that's why we had to do a 180 and switch about 2 weeks ago. But just another good resource to build your network and get some insights in the couple of weeks between meetings. So, real quick on the membership, couple of options. If you are an individual, it's $120 for the whole year. And if you're a couple, it's $160. That helps cover the cost of the room, the cost of the food, the website that we have, which has all of the recordings of our meetings going back to, I think, the beginning of 2017 when we started. That website has some costs. So all of your membership, basically, we pour back into the group. If you don't want to be a member, you can just pay as you come. It's $15 per month. We also have the Think Realty magazine for you guys. And then if for whatever reason you can't make it, like I had a lot of people text me today, kids are sick or a lot of homework or whatever, so they're at home. It's being streamed live on Facebook. So, who brought a guest? I have 3. Did someone bring 2 then? 2? Awesome. All right, I'm going to pick. So if you bring a guest, we do a raffle. I usually raffle 3 off, so it's appropriate that we have 3 today. We have our sports water bottle, the coffee, tea hot, and this actually keeps stuff hot super, super long, and then a $50 cheesecake gift card. So let's see, 671, just the last 3, 671. All right, and 642.
First we do.
Okay, I'll let you pick the first 2.
I'll take 2 coffee. Coffee, no coffee.
There you go.
Beautiful, sir.
And Maria gets the Cheesecake Factory card. So if you bring a guest, you get a raffle. Typically there's 7 or 8, so you have pretty good odds of winning something. All right, Frank, if you want to come on up. So this is a great follow-up to our meeting last month where we had Teresa here with Midland IRA and 1031 Exchange. And they are our newest vendor, so they picked up the IRA spot in the 1031. So if you're looking for a place to plant some money in an IRA, which again can grow tax-free, or tax deferred depending on how you set it up. That's a great contact for that. But she talked about with the 1031, by rolling your capital gains into another property, you're delaying your tax burden on that property. If you do it until you die and your kids or whoever inherits it, then their cost basis change. So you basically you can pretty much eliminate a lot of your capital gains by rolling and rolling and rolling. So that helps you down the road, saving on taxes. What we're going to talk about tonight can help you in the specific year that you do this. And this is called cost segregation. I'm a really, really analytical person, and I've seen some deep level stuff on this. You can go really, really deep. Frank's going to give you the overview on it, kind of tell you why it's something that you should consider, and then kind of show you a little bit about how it works. So let's give it up for Frank.
Can everybody hear me? Okay. Thank you. Thank you, Adrian. Thank you for having me here tonight. There are 3 handouts, 3 or 4 handouts you should have. Does anybody not have handouts right now? Okay, we got some coming around. While we're getting those, there is a sample cost segregation report on the back counter. Feel free at any time to pick it up and take a look at it while I'm here. It's very detailed, as Adrian had mentioned. A lot of them are. There's also a contact sheet in the back table on the side over here that you can fill out your name and telephone number if you'd like further information about cost segregation or any of our services after this evening. So while we're doing that, cost segregation kind of in a nutshell, I'll give you the nutshell, the low level or the high level bird's eye view of it. It's basically designed by the Internal Revenue Service many years ago to help investors recapture their capital expense of building a building or improving a site. And so what was happening in the 70s was that people were buying buildings, they were building buildings, and they had income from them, but they had no way of recapturing the expenses other than your utility expenses and those property tax expenses. And so it became difficult for people, other than the large corporations, it became difficult for the middle level and the lower level folks to invest in real estate and get a decent return on it because their expenses were so high. So what the Internal Revenue Service came out with in the 70s was the depreciation regulations, which allowed us to then start to depreciate these buildings or these properties over the useful life of the property. So what happens is, in the 70s, is it's instead of no depreciation expense, depreciation expense became part of the regs. And so a building in 1970 was depreciated over 19 years. So if you spent $19,000 on a building, your straight line depreciation would be $1,000 depreciated every year for 19 years until that building was fully depreciated. Then you had no additional depreciation expense. And so that's what was happening in the 70s. And then in the 80s, we had the Tax Reform Act of '86. And that changed how depreciation was calculated. In the 70s, it was calculated as a tax credit. So whatever the depreciation amount was, that number came off your tax return as a direct expense. Whereas in the 80s, it kind of flipped things around so that it's just a deduction instead of a tax credit write-off. So Tax Reform Act of 1986 made a lot of changes in the accounting and depreciation area such that investors were looking for other ways to maximize depreciation. And that's when cost segregation really took off. Now, I'd like to ask, is this too loud for everybody? Or okay? Has anybody in this room ever seen a cost segregation study or been involved in one? Okay. A couple guys in the back. Okay. All right. So what the study does is it breaks down your property into capitalized packets. So the building is 39 years now. In the 70s, it was 19 years, but now the building is 39 years. So, for example, if you spent $39,000 on a building, it would take you 39 years to write off $1,000 a year, and then that building would be written off. So that takes a really long time to recoup your expenditure on the building. So what cost segregation does is it takes that 39-year bucket that the building is in. This is the best analogy I could use because everybody can wrap their head around this. Look at your building components as sitting in a big bucket, and that bucket is full of 39-year property. So it's going to take 39 years to write it off. I'm going to change this just a little bit because 39 years applies to commercial properties, and I think most people in this room deal with single-family investment properties. So we're going to change this just a little bit. So single-family investment properties or multifamily, 2 to 4 units, they are depreciated over 27.5 years. So instead of 39, it's 27.5. It's a little shorter life. And what happens is you take 1/27 of that and depreciate it over 27 years. What cost segregation does is it takes your 27.5-year bucket, and everything's in that bucket. All the assets, the building, the site work, the concrete, the structural steel, the roofing, and your accountant is going to take that 27.5-year bucket and write it off straight line over 27.5 years. That's normal. That's how it normally works. And you should know that only about 7% of properties ever have a cost segregation study completed on them. Most of the reason isn't because they're not fruitful, not because they don't provide a return, but because most people have no idea that it even exists. And a lot of accounting firms know what it is, but they don't wrap their head around the mechanics of it, because it's kind of like, if you're an accountant, you know the tax law, you know the codes, you know what you can deduct. But when it comes down to breaking down a building into components, the accountants pretty much throw their hands up and say, we don't know what to do, we're just going to put it all in as 27.5 years. And that's normal. That doesn't mean your accountant isn't a good accountant. They're a great accountant, but they don't know engineering application. So what we do as engineers is we break down the building into the roof, the siding, the floor, the carpet, the ceramic tile, the backsplash in the kitchen cupboards, just the doors and windows, insulation. We break all of that out in that 27.5-year bucket. Whoops. And we are able to change it so that we have 5-year and 15-year property coming out of that bucket. So we pull out of the 27.5-year bucket and we put it in 5-year property. We pull it again and we put it in 15-year property and 7-year property. That's what the cost segregation expert does, carving out pieces of that 27.5-year bucket, putting it into shorter life buckets. Okay. So you might ask, well, what does that do? What's the benefit of that? What the benefit is that if you can write off components over 5 years versus 39 years, the present value of tax savings is greater than if you just use a straight line method of 27.5 years. It's kind of like if I were to pull a dollar bill out of my pocket, which I normally do when I'm on a one-on-one presentation and I give it to somebody, let them keep it. But since we have so many people in here, I'm not going to do that because they don't have enough dollar bills. It's kind of expensive to do that. So anyway, if I were to hand you a dollar bill and say, you can take this dollar today, or you can wait 27.5 years and I'll give it to you then. That's kind of what cost segregation is. If you take it today, obviously you can spend it in today's costs. If you wait 27.5 years, instead of buying you a Coke at the gas station, that's not going to buy you anything in 27.5 years. If you look at the time value, how 30 years ago, a loaf of bread was 10 cents and now it's $1.99. I mean, that's just how that dollar time value of cost savings over time. That's basically what happens. It's worth a lot less in the future. So what cost segregation does, it allows you to take items out of the 27.5-year bucket, put it in shorter life buckets, and you're writing off those shorter life buckets sooner. You're writing them off in the first 5 years, in the first 7 years, and the first 15 years. And then what's left in the 27.5-year bucket, you're writing that off between 15 years and the 27.5. So if we're doing our job right, what we will find is about a third of the 39-year bucket can get shifted over into the 5, 7, and 15-year buckets. And there's a present value calculation I'm going to show you that shows you what the benefit of doing that is. And in most cases, it's anywhere from 10 times return on investment to, we had a Meijer grocery store that was 385 times return on investment. So as the property gets bigger, the return gets bigger as well. And it also depends on the type of property. Properties that are very high in technology, or a manufacturing plant, as you can imagine, that has a lot of electrical and structural steel to support all that equipment. All of those types of things can go in those 5-year buckets. So the return depends on the type of property and the life. Now, the other thing that the IRS allows us to do is to do look-back studies. So what that means is, let's say you purchased a property 5 years ago, before you knew what cost segregation was. And now you know what it is, and by the end of this evening, you're going to know the benefits of it. We can do a study based on what you paid 5 years ago for a property and calculate these 5, 7, and 15-year buckets pulling out of the 27.5. And your accountant can do something called a 3151 change in accounting method. And what that allows you to do is it's called catch-up depreciation. So the depreciation that you should have claimed 5 years ago through cost segregation but didn't, you are now allowed to catch up that depreciation. So you may have had $75,000 worth of depreciation so far, but after doing a cost segregation look-back study, you're able to actually have, instead of $75,000, maybe it's $150,000 of depreciation. Now you might ask, what does that really do for you if you increase your depreciation? What is the benefit? So today was actually a big tax day for filing extensions, and so we all know what the federal tax forms look like. If you look at the income side of it, you have all your revenue listed, right? All your rental income. If you have coin laundry machines, you have that type of income. The income coming into your business is a plus, and then all the expenses going out of the business is a negative. And you add your pluses and your negative together, and at the end of the year, if you had more income than you had expenses, then you had a profit. And your tax liability would be based on a percentage, your tax percentage, if it's 25%, 30%, whatever it is. Taking 30% as an example, for every dollar that you increase your expenses through depreciation, through cost segregation, for every dollar you increase that, you're actually reducing the amount of tax that you pay by 30% if that's your tax rate. So for every dollar that we can carve out of that 27.5-year bucket and put into a 5-year or 7-year bucket, at the end of the tax year, you'll be able to write off more depreciation. And if it's, say, $30,000, you could write off more through doing a cost segregation study. And I'm just throwing that number out. It has no bearing on your property or anybody else's property. But if you could increase your depreciation to $30,000 or more, and you're at a 30% tax rate, that would be roughly almost $10,000 that you would not have to pay the IRS at the end of this year because you've increased your expenses to offset your revenue. So that's kind of what cost segregation does in a nutshell. Question?
Yeah. All right, so if you do that and you're accelerating depreciation that much, what happens on the back?
Can you tell me what the back end is?
Well, I mean, if you're going basically from, a 27-year depreciation to a 7-year depreciation, what happens in year 8?
Well, you still would have remaining basis in straight line property. So in year 8, your depreciation wouldn't be as great as it would have been if you hadn't done cost segregation. So it does decrease, but the early year write-offs.
Substantially decrease it?
Well, actually, we have does everybody have, if you look at this actual depreciation benefits? And I apologize, the numbers are really small, so my apologies. I know it's hard to read, but that's the only way I could get it all on one page. So if you look at the very left-hand column, I kind of skipped around here. Let me see if I can. This is going to take me just a minute here. I want to pull that up on the screen so I can point to the columns while you're looking. Okay. If we look at this column on the left, what this is showing us is that if you don't do cost segregation, your building is going to be depreciated over this 27.5 years, taking you down to here, basically. So that's if you don't use cost segregation. However, this whole model, this whole example here, has some information in the upper right-hand corner that shows how we broke out the 5-year, 15-year property. And so the rest of the columns on this page, from that first column all the way to the right, is showing us what our benefits are in cost segregation. So to answer your question, if you just did straight line depreciation, this looks like it would be $57,000 in year 25. I think that's what that is. Yes, 57,000 in year 25. If we follow year 25 over, we'll see that the depreciation is, it's in a minus. So it's minus 9,000, which is right in this area. So what happens is it goes from being a positive deduction in year 25 to a negative deduction because it's already accounted for up above in the early years. Now you may say that doesn't make sense because you're just losing it in the later years, but you're gaining it in the early years. But that time value of money, if I give you $1 today versus 27.5 years later, that's where that benefit is. Even though it doesn't look right or sound right, the benefit is that you're getting the money up front through a deduction. So if you could write a check on next year's tax return that was $25,000 less than it would have been had you not done cost segregation, then you would have $25,000 more in your bank account that day that you wrote that check. That $25,000 then could be used to buy the next property or the next property or to improve property B so that you can boost the rents 20%. And so that's what cost segregation does. If you're an active investor and you want to make money and not just sit on your hands, then cost segregation can work for you and help you make money. If you buy one property your entire life and you don't really care, you're just going to sit on this one property, and by the time you retire, that's going to be your retirement, cost segregation might be questionable for you. I still think there's a benefit, but the reason behind it would be less compelling than it would if you're an active investor using money to make money. So, Dean, did you have a question?
No, I think just based upon what the gentleman's saying, you correct me if I'm wrong, building is still depreciated different than with the cost segregation. You're accelerating everything that's components on the inside. Am I correct in saying that? Because that would probably help a lot of us understand the building's depreciating one way, and then all the fixtures and everything else is what you're accelerating.
Great point, great point. So the 27.5-year bucket is filled with everything, includes everything, inside of the building, outside of the building. And so when we go into a cost segregation study and we dig into that 27.5-year bucket looking for items, what we're looking for are things like carpeting, laminate flooring, strippable wallpaper, kitchen counters, kitchen cabinets, ceiling fans, decorative wall sconces, hardwood flooring. What we're looking for are components that can be categorized something less than a building. So if you can envision a building, even a multi-unit, 4-unit property, when they built it, it required walls and a ceiling and insulation and a roof and doors and a furnace and an air conditioner and a foundation. Those are the components of a building. Those are the 27.5-year items that are in that bucket. So what we're doing is going into that bucket, finding the shorter lived assets. And also the site work, which is also in that bucket, is 15 years. So we identify all of your exterior components, like your sidewalks, your grass, your sod, even topsoil, trees, shrubs, mulch, landscaping fabric, edging, fencing. I mean, anything that's you can envision that's outside of the building that's not connected to the building or part of that building. That goes into the 15-year bucket, pulled out of that 27.5-year. I see some hands. Yes, sir.
Like, isn't carpeting depreciated at 7 years, and like a furnace, isn't that depreciated at 15 years?
A furnace should not be 15-year property unless it would be some type of a tenant improvement. But if you're the landlord owning that furnace, that should be a 27.5-year item. As far as carpeting, so there are general categories for depreciation in the tax code. Carpeting you will probably find in a 7-year category in the tax code, depending on the application of it. So when we look at carpeting, we're looking at it as it being accessorial to that business as opposed to a furniture and fixture type category. So you are right. Some accountants will have carpeting at 7 years, some will have it at 5 years. The other thing that I haven't mentioned yet is so my background goes back to 1985. And we've worked with like Meijer grocery stores, Crate and Barrel, White Castle. We do studies all over the country. We've been in every industry possible. And so in order to do all of that and to have that background, you have to follow the tax regs. If there's a court case that comes out, there was a Morrison's cafeteria court case that came out several years ago. And what happens is the IRS challenges certain qualifications or asset categories for taxpayers. Meijer grocery store, they had a section in a room just for IRS agents because they're such a huge company. There's so much money there for the IRS to find and to dig up. That they basically provided them with a space to work. And so they would come in and audit their books, they would audit their depreciation schedule. So when you get into be a big, big company, you have eyes looking at you, eyes that typically aren't looking at like us in this room, the small investors. It's a whole different level. But my point is, when you're doing studies for large corporations, you have to keep up with the tax code changes and all these revenue rulings, court cases. And those court cases then tell us what we can accelerate at what life. That makes sense. Yeah. So yes, you're right in a sense, as far as the tax life. Yeah. Certain things like and I'm not going to get too much into the accounting principles of it because I am not a CPA, I'm an engineer with an architectural background, and I break down buildings and I follow the tax code to be able to do that effectively and properly. But your CPA would then get into things like repairs of HVAC systems. What's a repair? What's a replacement? What can you expense? What do you have to capitalize and write off over 15 years or 27.5 years? Those types of things your CPA would do for you. Now, we do work very closely with the CPA of our clients in every situation, with every project. So, we don't want to come up with something and put it in front of everybody and the CPA scratches their head and says, I didn't expect this. So, we're really working with CPAs. We have local CPAs we work with that refer business to us. We have national CPAs. And so, that whole process is, we're all working together to make sure we have a product that is, I want to say IRS proof. I guess nothing is IRS proof. We could all be audited tomorrow for any reason at all. Yes, ma'am.
I was just wondering, how does it come into effect if you have a building that you recoup, 5 years, 7 years, 10 years, and then you sell it?
Okay, very good question.
What is the question?
Very good question. If you have a building that you've purchased and you do a cost segregation study, so you've taken all this depreciation up front in the early years, and then you sell it in like year 7 or 8, shortly after the cost segregation study, how does that affect things? So my first question is, are you going to take that sale and make it a 1031 exchange, or is the example just you're selling it and cashing out?
Either one.
Okay. All right, so if you are cashing out, we have to run the calculation because there is a point at which you will have to pay the amount of tax that you would have to pay the amount of tax that you've saved based on the fact that you've written off the majority of the assets early on if you sell it right away. Typically, we say if you're going to sell it within 3 years after you do a cost segregation, you typically may not want to do a cost segregation. It may not be financially feasible. Your return may not be there. So, great question. If anybody has examples, the contact sheet back there, I'd be happy to chat with you and talk more about that.
But in that type of situation, would it be better to 1031 instead of just selling it outright and just taking the gas on nothing you still?
That's exactly right. And that was going to be our next example. So why don't we turn to that while we're on that question. Everybody should have this 1031 exchange excess basis calculation. So this is a real live example of a property. This was in an apartment building in California, in the San Francisco Bay Area. So we have the relinquished property, the downlay data on the top, which is section A, and then the replacement uplay data is below, and that's section B. So looking at the top piece, the improvements were split at an 80-20, 20% for the land, 80% for the building and site improvements. So in 2004, when they purchased that property, they spent $3.2 million. And then in 2019, they sold the property for $4 million. They basically had a 15-year gain of $800,000. Now, the $800,000 doesn't mean anything right now because we're going to move that into a 1031. So that kind of gets absorbed, and there's no tax calculation on that because it's moved into the 1031. So I have all those numbers up there. That 800 really doesn't apply as we go forward in this example. And then you would take away the total depreciation from the depreciation schedule, which is $1,396,000, and so the net basis for the down leg is $1,164,000. So that's the basis, the non-depreciated basis of the down leg. So then that carries, we'll see how that carries through to the next piece. The next piece is that they purchased a building in 2019 for $4.2 million, land at 20%, building at 80%, that's how it's split out. They had acquisition costs, attorney fees, and qualified intermediaries of 8%, which was $336,000. So that gets added to the basis. And so the basis adjusted is, or the net is $3,696,000. So then to calculate the excess basis for the exchange that would apply to a cost segregation study, you take the net basis for the uplay, which is B, and subtract A above from it, and you would get $2,532,000 as the basis for a cost segregation study on a newly acquired property. So that's how cost segregation would work in a 1031 exchange. Like Adrian alluded to earlier, and our 1031 expert alluded a month ago, if you can continue the pattern of selling and buying until you're ready to retire, there are ways that smart tax accountants and attorneys can shelter this so that it goes directly to your children with no gain at all, which is like kind of like the ideal situation if that's the reason for getting into it. So, any questions on that? Yes, sir.
Yeah, actually, I kind of wanted to go back to the previous example, not doing the 1031 exchange, but cashing out and paying capital gains. Because you had mentioned it's not probably the wisest decision if you're going to sell the property within 3 years of the study, but you also mentioned it wouldn't be wise if you were going to hold the property for term or longer. So is there a sweet spot, would you say, to make it worth your while to do this segregation if you plan on cashing out, not rolling over? What would you say is the sweet spot that makes this worthwhile?
Well, the example of hanging on to it forever was an example where that was your only property. And you wouldn't necessarily want to do a cost segregation to increase your depreciation if you were just going to sit on that one property your whole. So that was like over 27 and a half years, you probably wouldn't want to do a cost seg if you're just going to have one property in your portfolio. As far as what the sweet spot is, I would say if you're going to hold it for three years or more, then we need to talk about cost segregation. Because right now, I can't, I mean, there's some spreadsheet calculations we do. We look at the return, we look at how far you are into your depreciation. We look at how it's set up now. We also look at the land value. So what we do is kind of a cost oversight service. So we would just sit down and say, okay, let's look at where you're at on your property or properties, and then we can kind of give you an idea. I can't really say there's a sweet spot. There's a lot of variables.
Put over 3 years, basically.
Yeah, if you're gonna hold it for more than 3.
I got you. And would you also say, I mean, I'm assuming that's what you're getting at, but it's best served in a 1031 exchange?
Absolutely. I mean, there's really no situation that I can think of that, I don't know if Adrian agrees with this, but to sell a property and pay capital gains, I mean, yeah, if you're going to buy, the 1031 exchange would be the way to go to defer all that in infinitum. I mean, that's kind of the way it works. So, and the other question I get a lot is, I've owned the building 10 years. I'm 10 years into my depreciation schedule. Is it worth doing a cost segregation? So not only how long are you going to hold the building from now, but how long have you already held the building? So in that case, 10 years is about as far as you want to go into the depreciation schedule before you would consider cost segregation. Anything after 10 years, you really depreciated almost half of the property. And so the cost of our study would probably be, not profit, I mean, the return would be very low. I mean, we're looking at returns of 10 or better. If it costs 1,000, you're going to save 10,000. And those are not guarantees. Our fees are not based on a sliding scale or a percentage. The IRS frowns upon that. So, we just base the fee for doing the study, and whatever the results are, the results are. But historically, after doing 3,500 studies, I can tell you that 10-to-1 is about as low as it goes. So, yes, sir.
What about property value? Is there like a starting point? I mean, if I've got a house that's worth $150,000, do I go through all this, or should I meet a new threshold of $500,000 on a property?
It's a great question. It's a great question. I don't have. So I will tell you that the smallest one that we completed was 300,000. Was the smallest study we've ever completed. That's a study where front cover and a back cover and methodology and all the tables and 80 pages. That's the study. Now, I've also done work where an accountant will call me up and say, hey, can you kind of look at this and tell me what you would put in the 5-year bucket and what you put in the 15-year bucket, and maybe just charge me an hourly rate. I mean, we can do things like that too. We would want to make sure your accountant was on board with that type of application. So, yeah, I mean, as with any company, we're tailoring this towards the larger client, but being part of this group, and I'm realizing that most people have no idea. I'm really here just to teach and to tell you it's available, and if I can help you, I would love to help you. So that's really all I can say on that. Just contact me and we can talk through it. Okay. Let me back up. How much time do we have here?
20.
Okay. Sorry, I'm not as good with technology as I should be. There's probably an easy way to go right to the front. Okay. It accelerates depreciation on real property, minimizes income taxes for federal, state, and county. We haven't talked about all of those. So far I've been talking about federal depreciation, which is 25%, 30%, whatever it is for your entity, whatever type of entity you have. The The other thing I haven't said is that this is only for-profit organizations that file a tax return that uses depreciation as a deduction. So if you're a not-for-profit entity, you cannot use cost segregation because it doesn't really apply to you. Dean?
What if you use your own self-directed IRA to purchase a property? I mean, would that even make sense to do cost segregation off of it?
So the entity that is going to own it is your IRA?
Yes.
Or are you just pulling money out of the IRA and creating an LLC that's for-profit?
So the money would be a specific self-directed IRA with my own.
Yeah, your own, from your own 401k, but then.
But I'm not taking it out, I'm not cashing it out.
So the owner of the property is the IRA.
That's correct.
I've never seen an IRA ownership in tax records. I don't think I ever have. I'm going to bet that you're going to take the money out of your IRA, but you're going to put it in an LLC that you create that's a for-profit. I don't know why I'm saying that, but I'm saying that because I think that's how it works.
Okay.
Yeah, I would say talk to your CPA and see what they say. But if you file a federal tax return and you are for-profit, then you can use the depreciation deduction and it will help you save on taxes. So, also, state and county taxes apply as well because all of that net income flows to your state of Indiana and the county has a percentage as well that's paid through your either state, I think it's through the state return. I know there's a county calculation. It's a real small percentage, but so that would help save on that as well. Not as much as the federal, but obviously it would help. We've already talked about this. The 39 years for retail properties and 27.5 is for residential income properties. Without the study, it's pretty much always left in the 39 or 27.5 year. We're looking for our return on investments are typically 5 to 350 times. Most of our small residential properties we're seeing around 10 times return. We talked about this. Office retail, pretty much everything but residential income property is depreciated at 39 years. Average $5,000 study can yield $200,000 in present value of tax savings. So that would be your savings over time. Present value tax calculator we've already looked at. I'm just going to flip through this because we've talked about most of this. The other thing is that we complete these studies based on, if you buy an existing property, you probably don't have blueprints. I mean, typically nobody ever has blueprints. So in that case, we basically walk through the property with a clipboard and we're looking for all these things that we can pull out of that 27.5 year, put in 5 and 15 year bucket. So if this was the inside of a house, and I was walking through doing a study, I would look around and I would say, okay, those lights in the middle there, chandelier type lights, are decorative in nature. They're not part of the building components. They're there for decoration and ambiance. And also that soffit that's recessed, all of those lights, I would go after those as 5-year lights on both sides. And I would leave the middle lights, the recessed can lights along the side of these chandeliers as building lights. Track lighting is decorative in nature, so that would qualify. That exit sign can qualify as a sign. This is vinyl wallpaper. There's a court case that showed that vinyl wallpaper has the ability to be removable, so you can take it as 5 years instead of 27.5. You've got a security sensor. That would be a 5-year. We have speakers throughout the ceiling. Those would be 5-year speakers. We have a projector that would be 5-year, and this screen coming down, that would all be 5. All of these very expensive horizontal blinds would be 5-year property. The carpeting we would go after as 5-year property. The bar in the back, the whole bar, all the cabinets, all the faucets, all the drains, all the water supply to the cabinet. Electrical outlets that feed equipment. So in a kitchen, you have an electrical outlet that feeds a refrigerator. You have maybe a 50 amp or a 30 amp outlet that would feed an electrical range. The dryer has a 1/2 inch gas line coming to it with a 1/2 inch shutoff valve. You have a 4-inch gas or exhaust duct coming out of the dryer, going out of through the wall. It might be 10 feet long, it might be 20 feet long. You've got a screen on the end of it. All of that would be 5-year. So I'm kind of mixing properties together here now, but I'm trying to give you a flavor of some of the things we go after. So you might ask, well, how do you know how much those things are worth? You know, you would say, I just paid $300,000 for this 4-unit. How are you going to tell me how much that light fixture is worth? So here's where the engineering comes in. And this is why you really have to know what you're doing when you allocate the cost of a building. Because anybody can call their contractor buddy and say, hey, what do you think that light would be worth? What would you charge to install that? And he might say, 50 bucks times 10, that's $500 right off over 5 years. That might be his opinion, but you write it off over 5 years, and in 2 years, if you get audited, the IRS comes in and says, what are these decorative light fixture things you have here? And you say, oh, my buddy contractor, he said $50 a piece times 10, $500. That's what it is. That's what I deducted. And they said, well, show me how he came up with that cost. And you say, well, I don't know. He's a contractor. That's what he does for a living. And the IRS says, well, you have to justify all the costs that you depreciate, whether it's $1 or $10 million. So what we do is we come in and we find out that you paid $300,000 for this 4-unit. And the first thing we do is we deduct the land out of it, because land is non-depreciable. So let's say $50,000 for the land. So now we're down to $250,000 for the building and site improvements. So we are also appraisers, and we do a lot of commercial appraising and residential appraising. So we're always working with components of a building, as you can imagine. And we have all these estimating manuals that you can take the different type of building, whether it's structural steel, or it's wood frame, or whatever the components are, concrete tilt-up panels. We can go in and reconstruct the building based on the way it's put together. So we would reconstruct your 4-unit income property, and we would come up with, based on an allocation for that $250,000, that is the $300,000 less the land, so all your improvements are $250,000. We would allocate all these components to $250,000. Now that allocation would include a couple line items of interest, electrical, for example. Let's say we do our allocation and we find that there's $53,000 worth of electrical in our allocation. That's just general building electrical that any building should have. So what we do is we take the $53,000 in electrical, and then we go in our estimating manual for residential remodeling costs, and we find out that that light actually costs $82.79 out of this manual, because it includes the light, it includes 10 feet of conduit, and it includes 3 wires in that conduit. So now, instead of your buddy saying it's $50, now it's more than that, and we have something we can put our finger on if the IRS questions it. So we do the same thing with the speakers and the wall covering and everything, such that we take the $53,000 for the electrical and we quantify all these other things that should be 5-year, and we put them against the $53,000 and reduce the building electrical number from $53,000 to maybe $35,000, with the balance being all these qualified pieces of equipment. And so our study balances to the penny, to the $250,000, and we show all the references to the cost manuals, and basically, when the IRS looks at it, and you say, we had a cost segregation study, here it is, there's never really any questions beyond that. So we have only had, in 30 years, we've only had one client that has ever had a question from the IRS, and that was Meyer Grocery Stores. And the IRS wasn't sitting in the corner all the time. And they had a question on how we allocated the site work, the plumbing, you know, the incoming electrical, the plumbing, the sewer, the site drainage. And so we just went in there with a big blueprint and put it on the wall, and we showed how we color coded it and showed them how we quantified it as 15-year property. And they said, okay, that's it. That's all we wanted. And that's all we've ever had in 30 years. But anybody can be audited tomorrow. That's what I always say. So that's kind of the background on it. I don't know. I think we've gone through. The other thing I left or handed out was a brochure on cost segregation. It also has my card on the back. It talks a little bit about what we've talked about today. You know, I know everybody should just, you know, trust me like you trust your brother, but it would be really good due diligence to chat with your accountant about this. Some accountants will look at this as a great, you know, saving grace for you if you've got a big tax bill to pay, and they're knowledgeable on the tax regs on depreciation if they have a background in this, if they read a lot. What we find is a lot of accountants in the middle-sized accounting firms and the big accounting firms like the Crow and the KPMGs and all those, they're dealing with really high-end clients that have savvy tax departments, and they're all doing cost segregation on every penny they spend. So those accountants know cost segregation. They are 100% behind it. They know the value. They see the payback. But as you come down into the middle to the lower, you know, smaller accounting firms, you know, they're not as exposed to it. And it's not their fault. It's just their clients are smaller clients. They don't have the exposure to it. So some of them will kind of back off when they see cost segregation, and others will say, you know, I've read a lot about that, but I don't know that much about it. Who's this Frank guy? How can I talk with him? So that's what I would encourage you to do, is just to chat with your accountant. Call me anytime. I'm always glad to chat. Yes, sir.
Now, this is for only building owners. What if you're leasing and you improve a property? Can that be implemented? Can your strategy be implemented for that?
It can. It absolutely can. It's called leasehold improvements, and they are depreciated just like the landlord depreciates the building. We just have to be careful that you know, you're not depreciating these improvements as a tenant, and the landlord's not depreciating the same improvements as the landlord. Obviously, the IRS would frown upon that. But as long as we make that separation and we categorize everything for you as the tenant, it's the same application. The lights, it's basically the same thing.
Because the landlord may not want to do that, but you need it for your business. And he says, go ahead. You know?
Yeah, landlord would have no opposition to that because it doesn't affect them at all.
No, I mean the improvements. I mean, if you're a machine shop or something, and you've got to lease space, then you got to have improvements to operate your equipment.
Right.
So, okay.
Yeah, all of those improvements would qualify for shorter tax life as long as they weren't building related. So that's kind of
no double dip.
Yeah. Yeah. What other questions? This gentleman has his hand up first.
I have a question, and it goes back to classifications versus 27.5 to 39 year, because you backpedaled to go back to 27.5 for residential properties. And I may be completely incorrect, but my understanding was from a commercial lending standpoint, units 4 and less were considered residential and everything else was considered commercial. But from an IRS depreciation standpoint, any multifamily that gets greater than a certain percentage of its income from residential income is still depreciated at 27. Is that correct?
That's exactly correct. I'll just add a couple more things to it, though. A multifamily, if it is 80% or more multifamily use in the building, it qualifies as 27.5 year depreciation.
Is that why some of these new properties with the tenants below and then residential above are so popular?
Yes, because you can have up to 20% commercial space and still depreciate the whole building as 27.5 year.
They don't separate that out to where 20% is depreciated and 39 is just all.
Well, they do separate it out, but what it does, if you keep the commercial less than 20%, then the remaining 80% residential has no problem taking the 27.5 year instead of the 39. Because the commercial would be 39 on the main floor. So if you have 78% residential and 22% commercial on the first floor, the whole building is 39 years. So yeah, people are watching that. Savvy investors are watching that. Yeah. Dave?
What's the average turnaround time? I contact you, here's my 15-unit property, give you all the information. Are we talking 2 weeks, 2 months?
It's already done. It's on my desk. I just have to pick it up and I'll have it over to your office tomorrow.
Property comes with it, right?
I wish it was that easy. It normally takes, depending on the property, we normally quote 2 to 6 weeks.
Okay.
Now, on something really, we don't do a lot of small stuff, so I could maybe bang something out in an afternoon or a day and a half. I don't know, depending on what we're talking about here, but typically, like an apartment building with 80 units, we do that in 30 to 60 days. That's what we tell everybody. So something really small would be less than 30 days, and it could be less than a couple of weeks, just depending. I mean, if you have a quick turnaround need, we can accommodate that. It's not a problem. We just try to spread everything out as much as we can so we're not working.
And then do you have to initiate that in the year you want to use it, or you just need to have it done by April 15th?
Good question. So I'm going to give it, I may not answer this directly, but I'm going to say something that everybody needs to know. If you buy a building this year, let's say you buy a building tomorrow, your depreciation schedule has to be set up by April 15th of 2020 so that your accountant can calculate that depreciation on that tax return for 2019. So when do you do the study? You have to do it so that your accountant has the information before April 15th so they can incorporate that into that tax return. Now, should you wait till April 1st to call me? Absolutely not, because as you can imagine, we are like accountants when it comes to tax season. So, especially the smaller stuff, we're not going to want to write down on the wire. This stuff we want to get done early. That's all I'm saying. Did that answer your question? Or
Yeah, you just need to know.
yeah, yeah. Anybody else? Yes.
Are you, like, let's say you have somebody who's got, you know, a 10-unit, but 200 door apartment complex. Do you have to physically go into each room?
Good question.
Go through everything, or do you, with something like that, where it's not a commercial building that has larger spaces, are you able to lump it up by, okay, this 2-bedroom unit has this, and then there's 15 2-bedroom units at 100 feet?
So yes and no. You're pretty much right, but I'm going to expand on it. So 200 unit property comes in for us to do. We go out to the site, we meet with the facility manager. The first thing we say is, how many models do you have? They say there's 6 different units. We have 10 of these, 20 of these, 32 of these. We say to them, we need to go in one of every type of unit that you have, as long as they're all the same. You can tell us as a client that they are. So we would go into each one of those and do our thing on one, and then if there's 20 of those, we multiply the carpeting by 20, the lights in the ceiling by 20, and then that's how that works. Otherwise, if we have blueprints, then we can obviously see all 20 of those without going into the units. So yeah, but we typically do not take for granted what might be in a property. We will always try to gain access. We have an introductory letter that goes to the landlord or building owner. And it basically is written by me, but it's coming from the owner, and it says, we recently acquired this building on January 1st, and we've engaged AER Group to do a tax study for us. Over the next week, they'll be visiting the site from Monday through Friday from 9 to 5, and they will need access to your front areas, the back areas, all locked areas. Please give them access. If you have any questions, call me, the building owner. If you want to talk to the cost seg guy, call Frank. And then we say that we can accommodate either early or late in the day or after hours if we need to for some businesses. So, yeah.
You mentioned doing the cost segregation for before. So what can you give us some details about that? Is there, you know what I mean, backing it up so many years.
Yeah,
More.
so you just found out about cost segregation tonight. You've owned something for 5 years, and you think, oh, maybe it'll apply to what I have. So what we would do is sit down with you and just talk through it. Okay, what did you buy? How much was it? How many square feet is it? How many units do you have? And then, was it in great shape? Did you buy it and have to fix it up? And if you had to fix it up, what money did you put into it? Because then that fix-up money can become part of the cost segregation as well, and your accountant will love that as well. So I mean, that's how we would do it. And we'd look at what you paid. We look at your HUD-1 closing statement. We want that for our records, showing you paid X number of dollars for it. If you had an appraisal done, we want to see a copy of that appraisal when you purchased it, if you still have it. If you had any, sometimes in larger properties, they'll do an engineering walkthrough where they'll look at certain systems and test them and give an overall opinion of the condition of the components like electrical and HVAC. If those reports exist, we want to see those. Because keep in mind, when we walk through a building that's 100 years old, we have to come up with a value that ties to what you paid. And so a 100-year-old building, if there's an electrical outlet in the wall, it may not even be ground faulted. Okay, but we still have to value that. So we're looking at it. Is it three-pronged? No, it's not. Is this a, oh, this is a 100-year-old building. Well, it looks like it's been there for 50 years. So that electrical outlet, based on our cost manuals and depreciation, that electrical outlet may only be $25. Whereas the example I used earlier, it could be $85 on a newer building. So we're looking at observed condition, just like the roof. If we look at the roof and it's curled and we know it's got 2 years left, then in our analysis, that roof is going to be worth significantly less than what it would have been, if it was in decent shape. Now you may ask, why are you even concerned about that? Because that's a building component. We're not going to save any taxes on that. But what the IRS wants us to do is to value everything, not equally, but everything the same way. Because if I said that the building was worth, let's say you paid $300,000, and I said the building was worth $10,000, and all our 5-year, 10, and 15-year assets make up the difference, right? I mean, I could say that, I could calculate that if I didn't treat it as one building component and actually estimate it with all those components the right way. So we can't, we've got to look at things, observed condition and depreciate it accordingly. So, I mean, that's basically what we're doing with everything, whether it's carpeting. The carpeting may be brand new, or you may not even want to walk on it, it's so bad. Who knows? But that's something when we walk through, that's what we determine. We see a lot of hardwood flooring. For example, if there's hardwood flooring under the carpeting, we'll go after the carpeting is 5-year and the hardwood flooring. Because hardwood flooring is decorative in nature, so we're able to do that as well. So sometimes that can be a big item on even an older house as far as value and write-off. So did I answer your question?
I guess where I was going with it is cost, and is it more costly to do a back,
Oh, no.
and some of the nuances, I guess, is all I was curious about.
The cost is the same. All we're doing different is, let's say it was 2015 you bought it. All we're doing is we're using 2015 cost manuals when we value everything out versus using 2019 cost manuals to value it all out. So that's really the only different manual.
Okay.
Yeah. So the price would be the same. The procedure would. Yeah. Yes, sir.
I'm in the process of building a residential assisted living home, and it might not. I'm praying that it's done by December 31st for this reason. But if it's not, I still might be generating income from people putting money down on a room. Am I still able to claim that it's placed in service since this year, since I'm generating income from it? If I don't have the occupancy permit by December 31st?
Let me ask you this. We've done a lot of assisted living, and my experience has been that you cannot open the doors until you have a license to operate from the state. That is your key element. You can't open that building.
This is a little bit different. I'm not providing, it's not a nursing home. I'm not providing medical services. It's more of a residential style home. So I don't need a license from the state.
So the depreciation. So depreciation starts when you place your property in service. So that could mean that you just bought something today and you're not going to do any remodeling. You're just going to turn on the open site tomorrow and you're ready to do business. People are going to come in and access it. Your depreciation starts tomorrow. Okay, in that example. In your example, you're building something and maybe you won't have a certificate of occupancy, but you're going to have people renting. Will they be renting the whole, like multiple suites, or
There's 16 bedrooms, so they're renting a room.
will you have 16 occupants before you have the C of O?
Before I have the what?
The certificate of occupancy?
I might have 5 or 10.
Okay.
You know, I'm still gonna be giving tours and everything prior to opening the door, like getting the certificate of occupancy.
So what I would offer to do with you and your accountant is to sit down and talk through this. I don't have a direct answer because I would always caveat that we need to be talking together with your accountant. Because, I mean, my understanding on typical buildings is depreciation doesn't start until you have this certificate of occupancy or it is ready to operate for its intended use. So if the bedrooms are all ready, but there's other finishes that aren't, and that's why you don't have a C of O, then it's not really ready to function for its intended use. So that's why I say, I'm not trying to push you off.
I agree, but the way I'm trying to swing it, since I'm generating.
Yeah.
I don't know.
I would look at it the same way if I were you. Yeah, I agree with you looking at it that way. I don't have the direct answer right this second, but I could help you find it. Yeah. Anybody else? I think we've pretty much gone through. Let's see if anything pops up here that we haven't talked about. It applies to acquired or new property. Allows for catch-up depreciation. Okay, there's one important thing that I haven't talked about at all. Let me stop real quick. So, historically, we were able to depreciate accelerated property faster. If there's a 5-year asset, you depreciate 1/5 of it. Not really, but I'm going to use that as an example. It's double declining balance, so it's quicker than 1/5, but we'll just use that in our example. You depreciate 1/5 of it. If it's 15-year property, you depreciate 1/15 of it. And that's how it's been historically. And about 5 or 7 years ago, the IRS came in and said, we're going to give the economy a boost and allow you to write off your accelerated property with 50% bonus. So what that means is bonus is the amount above the standard deduction that you can take for that asset life. So if all your 5-year property totaled $100,000, instead of writing off $20,000 a year, you could write off 50% in the first year. That was 50% bonus in year number 1. So that's obviously a good thing, right? Because now you can write off in the first year half of your 5-year property. And the same thing with 15-year property, you could write off half of the 15 years or 7.5 years of that in the first year. So that was a big shot on the arm. And so cost segregation has been growing in appeal because of all of these deductions. Now, rewind to December 27th of 2017. President Trump signed the Tax Cuts and Jobs Act into effect in January 17. And what he did was he took that 50% bonus and made it 100%. So now all your 5-year property gets written off in year 1. All your 15-year property gets written off in year 1. Any property with a tax life of 20 years or less gets written off in year 1. It's a big thing I didn't tell you guys about until just now. So that's something that happened literally in the last year or so, December 27th of 2017. So now, anything that we pull out of that bucket, the 27.5-year bucket, put in the 15 or the 5-year bucket, or even if we create, there is a 7-year bucket, but there's very little that goes into it, so I don't want to talk that much about it. But anything that we pull out and put in those shorter life buckets now, you can write off in the year that you acquire the property. which is huge. It's never been like this. So out of everything else we've talked about tonight, this one little fact is just kind of pushes everything over the edge. Yes, sir.
Is that an option or is that required?
It is an option. Some people don't want the depreciation. There are certain reasons that your accountant will recommend you don't take the bonus, but that's a rare occasion. Normally, everybody's going to take the bonus that they can. But we've had people that have decided. So let me say this too: if you're not making a profit, then the additional depreciation doesn't necessarily help you this year, right? Because you wouldn't pay any tax anyway. But what it does do is it creates a loss carry forward that you can carry forward indefinitely. So let's say this year you can't use it because you don't have positive cash flow, but you know that in 2 years something's going to happen where the loan's going to be paid off or whatever, and you know you're going to have a lot of profit at the end of that year. This loss carried forward will go forward with you such that in that year number 3, you'll be able to use it to basically, I'm going to say, probably eliminate your federal tax debt that year. So just depending on how much cost segregation is applied. Obviously, the sooner you do it, the better. I mean, as time goes on, we all lose track of documents and numbers, and it just becomes more of a blur. Especially on acquired property, and even properties that you build with blueprints, they tend to get lost. May require more time if we do it later. Yeah, it's applied the year it's placed in service. Yeah, whether you build it, renovate it, or acquire it. So if you bought something and you're gonna do a $100,000 remodel, here's something you need to be aware of. So you come in there and you bring a dumpster in. You pay the $400 for the dumpster, and you fill it full of everything that you tore out of the property. The guy hauls the dumpster away, and you put the dumpster cost in you give it to the accountant, and the accountant uses it as a deduction. What have you lost? What haven't you done? Does anybody see it? You've loaded the dumpster with assets that you just pulled out of your building. What did you do? You threw away assets and you didn't tell your accountant that you threw them away. So the walls that you tore out, the ceiling you tore out, the carpeting you tore out. Now you may say, well, Frank, the carpeting has no value. Well, I would say, if you can walk on it and it covers the concrete floor under it, it has some value. It's covering. It doesn't have to be pristine, but it has value. There's a residual value normally of about 20% of whatever it is. So my point is, if you're tearing out walls, you tear out 100 feet of wall, or you tear out a 30-foot soffit, or you pull out the whole kitchen, take pictures of it before you do all that. And hire somebody like me, or do something to quantify what that was all worth. Because if you spent $300,000 on that property, you may have just tore out $20,000 that you could write off immediately. So be smart about that as well. So it's not just the cost of the dumpster you're deducting, it's the assets. Those are called retirements. There are so many apartment complexes that do this all the time. They'll take 10 units and they'll just gut them. And they'll throw it in a dumpster, and then they'll bring in all this new material, and they'll write off the new material, if they're lucky, and they'll write off the cost of the dumpster. But they've taken out, they never quantify how much they put into the dumpster. And a lot of them, if they have 200 units, they'll do 10 units a month, or 3 units a month for the next 3 years, whatever the number is. They don't even realize that they could retire those assets. So that's the other thing we do. We do retirement of assets that you replace. So if you bought a building and you remodeled it, we're going to do the cost seg on the purchase of the building. We'll also take care of the remodeling costs and segregate those out into the 5 and 7 year buckets. We'll identify the amount of retirement assets that you tore out, threw in the dumpster. If you take pictures before you do it, or you hire us before you do it, so we can take the pictures and understand what you're taking out. So, yeah, I guess these slides do help me remember some of these things in tax laws. But We just talked about this, bonus depreciation on used or new. So in the past, when we talked about the 50% bonus, that was just on new property. So now this new tax law is 100% bonus on new or used. So if you build a building or you acquire a building, it applies to either, which is another shot in the arm. This just talks about where the study is completed in our office, we use plans, or if not, we walk through the facility with a clipboard. We've been doing this over 30 years, doing this type of work. Experience level. Yeah, the IRS has something called the ATG, the Audit Techniques Guide. And you can go on their website and you can read all about it. It says that a cost segregation study needs to be completed by a professional, preferably engineer, who can break down the building and segregate the assets into the tax lives as per IRS regs and guidelines. And then they give you a list of what lives you should use for certain types of buildings. And so we follow that, but then we also follow the court cases on top of that. And a lot of firms got in trouble. When I started doing this back in 1985, there were only 24 firms across the country doing cost segregation. And over the years, there's thousands of firms doing it. But there are a lot of firms that don't have the tax background. The engineering background is fairly easy to get. If you can find an engineer that can break down a building. But the problem is that if you don't follow the tax court cases, you can get clients in trouble such that an IRS audit proves that there was one, AmeriSouth was an apartment community in Texas, and they had a cost segregation study done by a company who appeared to be reputable. By everybody's measurements, they were. They did the study, the IRS challenged it. The cost segregation firm stopped answering the phone calls of the client, which is a bad thing. And the client ended up hiring a tax attorney that didn't know how the study was completed. I mean, the tax attorney didn't have any of the details. So it was the client and the tax attorney against the IRS. And they basically, the client or the taxpayer had no defense. The IRS came in and said, we're going to disqualify this, this, and this. They disqualified just about everything in the study. Had that cost segregation firm defended the study and showed why why they actually qualified certain items based on court cases, it would have been fine. The other thing that happened in the middle of the court case was that AmeriSouth sold the property to somebody else in the middle of the court case. So they were just, and so that set a bad precedence for qualifying certain assets. But the firms that are still around that are doing it, that have been doing it for a long time, realize that that was an anomaly. And so we kind of know better. So anyway, any other questions? Yes, sir.
Who holds liability when something like that happens?
That's a very good question. So in our proposal, we say that we have been doing this for a long time and that we will support you in an IRS audit. We do provide you with 2 days of support time. However, if the IRS comes in and starts picking things apart and we have to go to court and there's additional fees, we do charge for those fees on a per diem basis. So, but we are there to support you. And like I say, we've done over 3,000 studies, and I don't know if you were here earlier, but we've never had one really go to audit. We just had questions up front. Most of the time when and I don't know if I told you, there's a cost segregation study floating around somewhere. Feel free to take a look at it, but it's very, very detailed. I mean, if an IRS agent looks at it, they're going to say, holy cow, where did you get all this information? And it's that detailed. So as opposed to some of the firms that just give you like a 2-page summary, here's your 5-year assets, your 15-year, and your 27.5-year. So we put everything in the report. Every calculation is in there. So it's served us well. Anybody else? I think we're at the end here. Well, thank you all for being here. I really appreciate your questions. Feel free to call me anytime if you have any questions. It doesn't have to, result in us doing work for you. If you just have some basic questions, my name and numbers on the card. I'd be happy to chat with you. Okay. There is a contact sign-up sheet on the side over there. If you'd like for us to call you or become part of our mailing list, feel free to sign up. I promise we won't call you every week asking you for work. It doesn't work that way. Thank you.
Is that helpful? I think that's my wife calling, asking for some more pizza. Was that helpful?
Yes.
I didn't realize about it. I'm sure I'm not alone. The whole retirement thing. I throw stuff out all the time, and I'm like, there's 20 grand of cabinets and flooring and other stuff that probably could have increased the deductions on. So thanks. That was super helpful. Boom, boom, boom. You have the mic? Cool. Who has a deal? If you are a wholesaler and you have a property under contract, or you are an investor or an agent with a property that you just listed that's investor friendly. Anyone? I don't see our typical wholesalers in here today. Nobody has anything. Need money, have money. No? Okay, I'll talk. I have a lot of stuff coming up by wholesale properties under Invest NWI. That's how we name this group as well. I have probably within the next 30 days, starting tomorrow, a dozen properties coming out. Maryville, Griffith, Hammond, Valpo. So if you're looking for something, contact me, sign up on our website. But more importantly, don't just sign up on the website and wait for a deal. Give me a call and let me know specifically what you're looking for. Because I know when we send out the emails and the text, not everybody gets it, because I can see based on the analytics how many people open the email. But if I know that, hey, DeMarcus calls me, hey, I'm looking for properties in Griffith. Well, when I send one out and I see he doesn't open it, I'll actually call him, hey, you said you were looking for something, so let me know what you're looking for. I also have a number of rental properties from single family up to a couple of 4 and 5 units that we're starting to liquidate. So if you're looking for stuff that's already occupied, I'd be open to chatting with you about that. So my card's on the table there. So reach out to me about that. Make sure you bring your deals next month. If you bring your deals next month, just put them on the table with all the other vendors as well.
What are some good tips on getting your first?
That's a great question. We can have coffee over. I think it was like 2 or 3 months ago, we talked about how to find off-market properties, so that'd be a good video for you to watch. Next month is October 21st is when we are meeting. Back here, we're not sure if we're going to be in this room or that room, but we'll be back here. Our guest speaker is a topic I've been trying to get for 2 years, but with the market being as crazy as it is, they've been super, super busy. I have Aaron Ingram coming. He's an appraiser, and he's going to walk us through the appraisal process. So, for those of you that flip properties, there's a certain way they evaluate that. If you're doing a rental refi, I know a lot of guys are like, man, I didn't get the value I wanted. Well, there's a reason on a refinance you don't get the same value you get with a flip. He's going to talk about the FHA inspection issues, conventional inspections, all of the different things they look for in a house, and then how they value the houses. So that will be a fantastic topic, and that is next Monday. So we obviously have plenty of food for tonight. Pizza is on a first-come, first-served basis. If you want to take an entire box home, we're not going to judge you. Same with the cookies and the soda. So thanks for coming, and we'll see you next month.
This is right.
So I was just,
Likewise.
you know, so when I was sounded like
Usually you go find them all together.
But I mean, you want to,
Anyway, I worked in a dollar, 645. Like got it for 515. Got it budgeted by 540. I would have been here, I should have been, it's an hour, so I've been here at 645. And then the next week, the person's like, I'm like, you guys at the airport yet? I've been there 5 hours before your flight, 7 o'clock. At least, okay? I'm like, no, that's all I get to know. I'm okay. And I thought, well, we landed, so I just texted when we landed, nothing else. And I'm like, we're getting our luggage, are you going to be 18 or whatever it was. I literally went, I'm like, what's your confirmation for the next week? As soon as that meeting, they're going to park in the garage. When we left arrivals, they can pull in and they said, can you write back? Did somebody drop you off? Yeah. I was gonna like, somebody will find, I was going to call but I don't have to know. I think this literally dropped me off in the airport. So I was like, and then this one, I actually listened to it. So I was actually, I started driving and that day when I drive, and I'm like, hey, you start actually listening to a live event, but I can't. So I can't put it there. Because I didn't have it connection. So I'm like, we had a stoplight. I'm like, oh, just hit the stoplight. We're switching drivers, because then you don't hear this. We switched to what they hear. Sound better. Don't on the road. Just roll up. So like we switched it, so I was able to listen to all that. I started late until later, so like, okay. Did you ever know if they made it? Yeah, I did. I'm like, I'm sure they did. So I was like, how many minutes? You're 8. 6:52. We just got 3 minutes before. Like, oh yeah, like, yeah, because it was like when the flight was at 7. So they must have got to the gate. Well, like they cut off. She said they only got the last aisle. So like they had lists. They would have before us. So what did they do? Fly? We flew into them. Oh, I know. So the last one. What do you do? Fly where? You have to see he have his last seat available, or did they actually have their?
No, they had, they were good, they were being shopping around, and they did pretty fine. I think they were already got in, they were early, so they were like, anyway, we're having on, so we had arrived at the wedding, and it's yes. So I'm like, send me your confirmation. I heard you go through an hour long. Right, but that's what I said, the thing is, they could have, I didn't tell them that. If they were that close, I guess, they would have just said, I was like, this is 7:25, like, can you put this in front of the I don't mind waiting when I have time, but those are fun, and it's less like that. So they, I don't know if they did their security. The last time we got the security, we went back. We went.
I've never asked. Does security have to let you do that?
I don't know. The last time we only went, it was really not. So on the flight, before our flight. So they put us, the flight put us in that one. So we missed that flight by 15 minutes. We already had other flights, so it didn't matter. So we were just very, very early to the other flight. Anyway, so I didn't ask. I almost didn't, like that's the flight. They told me there was like several people on standby anyway, so we didn't have anything. So that might be no, so they had their flight. So then, so I said, send me your confirmation. So I went on the kiosk, I couldn't know boarding passes and all the luggage check. How many pieces of luggage you have? And I'm like, do you have a stroller? Do you have a car seat? They're big car. No, evidently they're renting on their own. It's not the big deal, but yeah. But they anyway, so they made it, but I was like, I didn't want to like reel them over, but I'm like, so she just said she was being raised by this skin or chin. And I'm like, yeah, that was way too close for me. We'd be here. I thought for sure we'd be here. They were just parking the garage. They had this car in the garage for an hour or two. We got there. And they're sitting with me there. I'm like, oh my God, you wasn't here, right? I was like, I was trying money. But I was in there. Beautiful. We only got rain on a little bit one day, 2 days, like 10-minute rain. We were on the jungle and both the girls were on weekend. No, it's like going through the Nile River, the animals, safari, yeah. We're in there, we go under a bridge, we come up and record, like from the time we entered, to the time we had to start recording, and we had to put a cover over our head. It's like this way, this is kind of the movement here for handicapped. So it's covered in the middle. Well, when they opened it, it was off. All the rain went in the side. So like, we got little rain, nothing. I was watching the weather. Like nonstop for days. Like we avoided this is the best I've ever. Like so, it was warm. It was warm. It's always warm, but I mean, it was September warm versus July warm. So someone takes me back. She's like, well, I'm just checking flights, Mom. What was for? Well, she wants my mom. Yeah, she wants my mom. Like 2 park days. But she was trying to make me the lineup. Which one did you guys stay? They switch every 2 nights. We stayed at Pop Central. They still switch resorts every 2 nights. How many resorts are there? Well, they do every time. So, say Pop Century might have a lake resort, and then it will have. Because you have to every different type of set. Right. So there would be 3 of those sets. So we could there's 1 bedroom, or 2 bedroom, or 3 bedroom. So that's why they're still. But